And to talk more with us on stocks and the global economy is Justin Harper of IG Markets. Morning, Justin.
Morning.
The question we're asking this morning, are the bull market signs broadening amid resilience in the US economy?
Yes, I think they are. We've seen, a lot of positive data coming out of the US, particularly last night we saw the services industry is growing as well, which is, a huge part of the US economy. About 90% it makes up of that economy there. Hopefully on Friday we'll see some excellent data coming out regarding more job creations there. So, yes, definitely good signs of the bull market. The problem is that it's all coming from the US at the moment, as we saw with China and Europe there. They're faltering still and slowing down. So it's a sort of one-horse race at the moment.
Now, the MSCI Japan Index rallied more than 11% in February, its largest monthly gain since 2008. It actually beat the Dow by nearly 9 percentage points and topped high-fly markets, including China, Korea and Brazil. So will the rally continue there?
Yeah, I think the Japanese sort of market has, done really well, and 13% in February is, great performance there. And as you say there, it's beaten a lot of its peers across the world. It's just, will this rally continue? Because it's boosted by the fact that the Bank of Japan has intervened and pumped more money into the economy to try and bring the yen down and help its exporters there. So, it's sort of been skewed by this cheap money coming into the market. And you have to question, when that cheap money goes, will this rally continue? And that's really going to be the litmus test for a lot of these economies and markets that have gone up. When the government stop pumping money in, what will happen to the economy? Can they, will they be able to ride on their own? And we don't know yet with Japan.
Okay, now equity prices have risen in lockstep with oil's advance. So when the two rise together, does it indicate a broad-based economic expansion?
Yeah, I think, both are sort of heading upwards at the moment there, but there will become a point where oil will just become too expensive. It will, there'll be a breaking point there where it will start to damage the economy and future growth. And we'll be coming to that point soon if Middle Eastern tensions increase. But you have to remember the fact that this isn't just about geopolitical tensions. This is also demand for oil has been increasing as economic growth has increased. So the two go hand in hand up to a point, and then when it gets to a certain sort of, crunch issue, then, economy will start to suffer.
Okay, now all eyes are on the US jobs report for February, which is due out on Friday. Do you think unemployment's going to continue to get better?
Yeah, I think so. The US has been creating jobs month on month now. At first, people thought it was like a flash in the pan, but it seems to be more sustained now. The economy is growing there. We've seen services figures come out there, and manufacturing generally is sort of, recovering there. So, everybody's expecting Friday to show some good numbers there. The market's already hoping that the US will sort of lead the way out of this, out of this sort of tough time. So, yeah, all fingers are crossed for good figures on Friday.
Right. Eurozone debt woes continue to hurt the region's economy. Is the common currency likely to weaken in the mid to long term?
Yeah, I think with the Greek agreement that was signed a couple of weeks ago, the markets had priced a lot of that in there. The euro dollar hit 133. It was pretty high. And then we saw a lot of profit taking there from traders, thinking this is as high as it's going to get in the short term. And now we've had that profit taking. The market's come off a bit there. And we're in a bit of a lull at the moment because people are thinking, well, what's the next big news to come out of the Eurozone? And at the moment, there seems to be nothing on the horizon to push the euro higher. So, I think it will be flat for a little while, a bit subdued as traders wait for any sort of more positive news out of the Eurozone.
Let's talk a little bit about yesterday's big news. Of course, China's lowered its GDP growth targets this year to 7.5%, down from 8% for the past 8 years. Are we going to see further monetary tightening by the central bank?
I think a lot of people expect now that the GDP growth has been revised downwards there. But, it's a clever move by the Chinese to take the pressure off and say, look, we might not grow as fast as you expect us to there. But come the end of the year, if they do, come in better than 8%, the markets will obviously see that as a good sign, and that will be good for the Chinese economy. So the pressure is on now the Chinese to say, OK, now you've revised the figures. How are you going to pump more money in and keep the economy stable there? So I think a lot of people will be expecting this now. But I don't think the Chinese government are going to, press the panic button anytime soon, because 7.5% is still very healthy by anybody's standards there. And for the Chinese, you have to sort of think, do they know what they're doing at the moment? They haven't proved us wrong there. The slowdown is happening. They've engineered this slowdown there. So I think they're in control of things at the moment. OK, so what's the news going to mean for Asian economies in the region? I think obviously, the fact that China has come out with these figures there out of the blue and said that, growth is going to be slower will affect Asian economies there. Also, we've got the fact that Europe is slowing down and could be on the brink of recession as well. So there are some tough clouds ahead. We've mentioned oil before there. So, you know, Asia is sort of sit and wait, see what happens with the other big economies there, and hopefully ride out this short-term storm.
Well, thank you very much indeed for that, Justin. That was Justin Harper of IG Markets Singapore.